Thank you. All right, so I'm going to go ahead and call this work session to order on AO 2020-115 and energy efficiency. Let's go ahead and start with the roll call, please.
Miss Allard? Mr. Constant?
Here.
Mr. Dunbar?
Here.
Ms. Kennedy?
Here.
Ms. LaFrance?
Here.
Mr. Perez-Verdilla? Mr. Peterson?
Present.
Ms. Quinn Davidson?
Here.
Mr. Rivera?
Present.
Mr. Weddleton?
Here.
Ms. Zolotel?
Here.
All right, thank you.
Thank you. As usual, if members want to get in the queue, please put yourself in the chat or text me if you can't access the chat. All right, so for today's work session, we're going to go through, Ms. Kilcoyne is going to do a presentation on the ordinance we have before us, and we're also just going to do a general discussion around some of the processes for CPACE and what we might be seeing in the future. So go ahead and turn it over to the administration.
And should I be sharing my screen then?
Yes, please.
Thank you. Okay, are you able to see the split screen or the whole screen?
We can see the whole screen.
Excellent. Okay. Thank you so much for your time on this. I'm going to be talking, of course, about the kind of whole picture of clean energy financing, and I'm going to give
Ms.
particular.
Kilcoyne,
Sorry?
apologies. Actually, now I understand what you're asking. So we're not seeing the presentation in full screen mode. We're just seeing normal PowerPoint view.
Are you seeing the notes and everything?
We are. Can you?
Yeah, we can see notes.
Okay, great. Yeah, I think that's probably going to be distracting. So let me try again. I think this one. Is that correct? Full screen now?
Bingo, that's full screen. Yeah.
Okay, excellent. I'll keep her rolling then. Yeah, thank you again for this time. My name is Shana Kilcoyne. I'm the Energy and Sustainability Manager for the municipality at Solid Waste Services. And this is meant to be an overview with, again, a little bit of more focus on CPACE. So we'll talk about clean energy financing and why it's important, CPACE, and then I'll get into property tax credits, and then the Anchorage Clean Energy Jobs Fund, and then we'll have questions and answers. I am going to get a little bit wonky in some of this, so please do put yourself in the queue and interrupt me. And I do have some pauses for questions after we go through each of these. So the need for clean energy financing, well, in the aftermath of COVID-19 pandemic, of course, budgetary challenges and the overall economic outlook are likely to worsen. There's a need now more than ever to develop new tools that efficiently create jobs and build clean energy projects in the state. So by targeting barriers in clean energy projects, creative financing can unlock projects and reduce risk, thus encouraging economic development and facilitating private investment. These types of projects create jobs, improve the value of our building stock, create healthier and safer indoor spaces, save energy and money, and of course, reduce the emissions from buildings, which is the backbone of the Anchorage Climate Action Plan. With an energy mix that is highly reliant on fossil fuels, Alaska can really benefit from more diverse sources of generation that increase its resiliency. And so electricity costs here in Anchorage, I'm sure we all know, are almost double that of the national average, and our population has high energy needs. So that means that customers in Alaska can really see large savings by reducing energy use. Anchorage in particular has set ambitious goals for greenhouse gas reductions, and now we need the tools to realize those goals. We had actually 4 different actions in the Climate Action Plan that explicitly call for mechanisms to help finance clean energy. Specifically, Action 3B calls for identifying and developing financing mechanisms such as a green bank, and 3E to establish a commercial property assessed clean energy program in the municipality. So now I'll talk about commercial property assessed clean energy, CPACE. A lovely name, of course, but that's what it's known as in many existing programs already. Property assessed clean energy, or CPACE, is an innovative finance program that enables owners of commercial and industrial properties to obtain low-cost, long-term financing for energy efficiency and renewable energy projects, and then they're able to pay those costs back over time through a voluntary assessment on the property tax. So the unique characteristic of PACE is that the assessment is attached to the property rather than the individual. PACE financing is intended to cover the full cost of eligible improvements with little or no upfront out-of-pocket expenses to the owner. Generally, as with other special assessments in Alaska, the assessment under a PACE program is secured by a lien on the property until it is paid back. The PACE obligation does transfer automatically to the next owner if the property is sold. This has a couple of benefits. For one, in these uncertain times, a business can fund 100% of hard and soft costs on the projects, which reduces their energy costs at a time when businesses are really needing to tighten their belt. And because this arrangement allows property owners to spread the cost of the energy improvements over the full expected life of the improvement, the idea is to create a revenue stream right from the beginning. And so if they don't know, for example, if they'll be in that building for the next 7 years, which is the payback of, say, a lighting retrofit, maybe they're going to grow out of it and move into a different building, they can sell that property and the assessment will go with it. This allows us to improve underlying building stock, reducing energy costs, all with private financing. So it's market-based. All financing will come from private lenders and not the municipality. To date, we've
just
got 30.
Just want to note
Yes.
really quickly for the record that we've been joined by Ms. Allard. Thanks.
To date, 37 states and Washington, D.C. have enabled PACE legislation. This may be innovative, but it's not a new concept. Nationwide, through commercial PACE, we've seen $1.54 billion that's been invested for an economic impact of $2.8 billion, and that's through 2,400 commercial projects, creating nearly 18,000 jobs. And the 2017 in Alaska is referring to our state's enabling legislation. So CPACE as a public policy, this says that commercial clean energy projects are a public benefit. And so the way it works is the state passes enabling legislation, which was already done. A local government creates an energy district by passing an enabling resolution and ordinance. And then a building owner selects a project. They'll work with a contractor to do this. They will work with a capital provider to provide financing. They then apply for the assessment to the municipality through the Office of Economic and Community Development. And then the municipality will record that, and that secures the financing. From there, the building owner will pay the tax assessment, which is forwarded to the capital provider. So like other public benefits, these are secured by the building and not the building owner. We actually already do these mostly around water and wastewater improvement special assessments. You might have noticed AWU's presence in the documents that you've reviewed, and that's because AWU currently handles all special assessments. Again, this is an entirely voluntary program, and the building owners work with contractors to select those projects. This is an example of a transaction structure. It's a little bit repetitive of what we just went through, but the commercial property owner goes through an underwriting process through a private capital provider, and then the borough, or in this case the municipality, has the assessment recorded. And then we work with qualified contractors to install the project. Sorry, not we, but the business. And then this kind of goes back into a loop. The property owner, if they sell the property, the assessment stays with the building. I'm going to talk more about the qualified contractors in a little bit. So there are many benefits for property owners. The property-backed structure is secured by a tax lien, and this allows for $0 down financing and then long repayment terms. This is up to 20 years or the life of the project, whichever is shorter. We can work with private financiers. They feel more secure about doing a low fixed rate interest due to the assessment. Projects are cash flow positive from day one, so they're structured so that the savings are greater than the loan payment. These are secured by the property again, not by an owner guarantee, a bond rating, or a credit score, and then the obligation again transfers with the building. The assessments may pass through to tenants, and this can overcome a split incentive, say if the tenant is the one that pays the utilities. There are, of course, benefits for local governments. The structure, really, the main thing is that it drives job growth and economic development and efficient, resilient energy use. So now more than ever, of course, we're eager to drive private sector investment. These projects improve our taxable property base, create good paying energy jobs, and help meet our clean energy standards, which also improve air quality, which we've learned is particularly important in COVID times. And because PACE utilizes the municipality's existing method of levying and collecting payments, the added costs are expected to be minimal in the early stages of the PACE program. We're responsible for the municipality. We're responsible for recording the benefit assessment, billing per the repayment schedule, processing payments, and remitting funds. Nominal staff time will be required from existing staff to take intake and review applications and to levy the assessment. Further, the municipality may impose fees to offset the cost of administering the program, which is what we expect to do. This program is anticipated to be revenue neutral, and thus no summary of economic effects was included in the ordinance to establish the program. And then, of course, there are benefits for not just businesses and the local government, but also developers who can drum up business, lenders who can drum up business, and communities who can take part in this opportunity. Now, it's particularly, I've mentioned that this is particularly important during an economic downturn. This is an important source of credit that property owners are needing to make upgrades to their properties. CPACE lenders in several markets actually reported increase in queries and new activity in CPACE. And they expect that these new applications, or the new applications, are coming in from two main groups, which are small business owners and property developers. They expect that the small businesses are needing to tighten their belts right now and looking to lower their costs to stay afloat. And for property developers, they expect it's a means of selling more projects because their sales have likely slowed during the crisis. So we're definitely seeing a lot of more activity right now, which was kind of surprising to me. I didn't know what to expect there. Of course, you've seen the resolution on September 15th, which passed unanimously. And this said that the establishing that financing of energy improvement projects through assessment serves a valid public purpose. And then the ordinance was introduced on October 13th. Our state statute was fairly prescriptive in outlining what is needed to establish the program. For example, the content in the program report was outlined in the statute. So the program report may have looked a little bit long and daunting, but that was all required. And I want to note that the contracts included in the program report attached to this ordinance are form contracts, which are meant to serve as a sample contract and not the final documents. So we're still working on the exact program process, which will allow us to establish our fees that offset our costs and therefore will establish the final documents. Back to the fees, these will be declared in the official PACE program application and the owner and lender contracts, as well as the final Anchorage program report. We are also able to work with the experts at PACE Financial Servicing to develop the program documents. This looks like a complicated program when you're reviewing some of the documents, but really we're putting in the work up front to establish a program that is quite simple. The Assembly passed the resolution on September 15th, and now we have a ordinance that was introduced in October to establish the program. Per the statute, the Assembly will hold a public hearing next Tuesday before voting. I also want to note that we've been working with the Alaska PACE Advisory Committee, which includes stakeholders from representing banking, contracting, real estate, and a number of municipalities and government organizations. And within this committee, we decided that it was imperative to really standardize the program as much as possible for fluidity between regions. So our hope is that all programs established in Alaska can look and operate in a similar fashion, so that if, say, the Matsu Borough wants to pass a PACE program as well, any businesses or lenders that work in both regions don't have to learn entirely new programs. I apologize for the amount of text on this slide, but there are some important aspects of the program that I just want to point out. First, the assessment financing amount. This just means that both hard and soft costs, including permit and inspection fees, etc., can be included. For the maximum financing amount, so this is 20 years or the useful life of the project, whichever is shorter. And then we also have a 20%, oh, sorry, that's the next one. A 20% limit to the assessed value of the property. That is, I think, intended to de-risk projects, but it is quite limiting. And you can see that there's a potential waiver, and I think that we would definitely be interested from the get-go in developing how that waiver could be applied, what the process for that would be. If our average building stock is about $1 million in value, that means the 20% limit means that we cannot exceed a loan through an assessment of $200,000. For the lender consent, this just means the lender is agreeing to basically a lower lien position. This assessment would be the second assessment, or sorry, the second would take the position of the the first lien, with the mortgage taking the position of the second lien position. For savings to investment ratio, or SIR, this means the projected savings due to energy and maintenance must be more than the financed amount. For example, a business would probably never be able to finance just windows through this, as they most likely won't pay back in under 20 years. So the project needs to pay back within that 20 years. For project review and verification, this is an important piece. A qualified energy auditor must review the baseline conditions and projected energy costs and consumption and the savings of the project. This again reduces risk and ensures that the project really does pan out. The qualified contractor must also verify that the project was properly completed and operating as intended. For direct acquisition by owner, the owner can purchase the equipment and materials directly. That one's pretty simple. So I kind of tried to pick out some of the more important pieces of CPACE as you've been looking for it, and now want to pause for any questions, especially since this is coming up next Tuesday for a public hearing.
Great. Thank you so much for that thorough presentation, Ms. Kilcoyne. Are there any questions? Yes, Ms. Zalatel.
Thank you, Mr. Chair. Ms. Kilcoyne, I may have missed it, and I apologize if I did. What will be the municipality's role in advertising or getting the word out about this program, and how do we plan to do that, and to what cost? Thanks.
Great question. Thank you, Ms. Zalatel. So we are expected to do the education and outreach and the marketing, which is a big part of this program. We will be doing that internally at this point between the Office of Economic and Community Development as well as the Sustainability Division. But the big piece here is actually that we are still working under a contract that is paid for through a grant through the Alaska Energy Authority. We've been working really closely with PACE Financial Servicing, which are subject matter experts in PACE. They've helped us with all of these documents, in fact, they created these slides. They've done a lot of the legwork for us, which has saved us a ton of time and energy, and they have created a statewide website. They are creating a lot of our materials that we can just kind of redesign as we want to fit Anchorage and go ahead and use. So that's part of the urgency here is the more we get done now and the further along we get, the more we're able to access that expertise from PACE Financial Servicing, again, at no cost to the municipality.
Can I ask a quick follow-up, Mr. Chair?
Sure.
Thank you. So this may not be something I have an answer to, but I'm curious with our technical support and assistance, what kind of equity considerations have there been to make sure that we reach a whole spectrum of individuals who may qualify? As you know, we are working hard on equity issues within the municipality, and I wanted to know if there'd been any considerations about that.
You know, when I come to equity considerations, I mostly am thinking about residential. I have a harder time with the commercial side of things. That being said, this is a great tool for kind of expanding potential property owners, because again, it's not dependent on their credit score. You're using the building as the equity in the assessment. So I think it does expand who would be eligible for a loan. If they're not able to get traditional financing, they very well could make it work through the PACE program.
Thanks.
Thank you. Mr. Weddleton?
Well, thanks. A couple of questions, and one kind of popped in. If someone's got a building that takes 20% of the assessed value to get these energy improvements, I think that would trigger, if it's I figure it's an older building then, so it may be out of conformance with Title 21. So all of a sudden now they have to come in conformance with Title 21 to some extent. Would this kind of work trigger that?
That's a really good question that I might have to lean to building safety on, but I think that you could be very well right on that.
Because that's an incentive there. Say, okay, if you do this stuff, it won't trigger having to put in a sidewalk or more landscaping and things like that. That additional cost that probably wouldn't be covered.
And he might be able to respond to this.
Perfect.
Thank you, Mr. Through the chair. Thank you, Mr. Weddleton. Good question. And the short answer is this does not impact that particular measure. And it's hard to say what triggers would or would not be pulled by virtue of someone coming in with an older building and whether or not they would need to bring certain provisions to code. I do think that if there is an opportunity for commercial property assessed clean energy projects, it does create an opportunity for, or actually, I guess I should say, it should probably be triggered by opportunities for other types of renovations and improvements in a property. I guess that's a long-winded way of saying I can't imagine a building that needs a high degree of improvements for building safety purposes to want to come in and do the CPACE program alone. But again, long-winded answer. There's not an easy way to answer your question because every property is different. But this lives outside of, or I guess side by side with any requirements in the building code.
I was thinking more Title 21 stuff. If you trigger need to come into conformity, I think it was 20%, and then you have to spend 10% of the project money coming into conformity. And that could
Yeah,
up your,
through the chair, yeah.
and all of a sudden it's out of
That is
pocket.
correct, but again, that is correct, but without identifying a specific project, it's hard to say whether or not this would be that would be triggered as a result of this program if an older building wanted to utilize the CPACE program.
Mhm. Okay. Can I ask another?
Go ahead.
If there's others, I can wait. Okay, so another question I'd send in, and it's just, I mean, I think this sounds like a good program, but there's some things. So, you know, I wondered how this would work with income taxes. You know, like you get a loan, you can deduct from your income the interest you pay on that loan. And if you do this, how is that broken out so you know how much is interest and how much is principal?
I think that might be a question I need to confirm with AWU on how it is already done. I would think so. Mr. Schutte, do you have an idea on that, the answer to that?
No, but we can get back to Mr. Weddleton.
Okay. And then a third one, if I could.
Actually, if you don't mind, I'll go ahead and put you at the bottom of the queue.
Sure.
We'll get back to you.
Yeah,
Thanks.
that's no problem at all. Thanks.
Ms. Kennedy?
Thank you, Mr. Chair. My question's in regard to the mechanics of the financing. So this is a loan. So maybe I missed this, but I'm trying to understand actually the connection to this financing or this loan to our taxing authority and to our assessment processes. So can somebody cue me in on what those connections are? Like I said, kind of the real mechanics of how this is supposed to play out. Thanks.
So the
Hey,
connection.
Shana, this is Alex Slivka, CFO. I guess through the chair, they're completely unrelated. This is just a process whereby we can facilitate energy improvement, and it's not related at all to our the taxation and assessment of property, other than the possibility that maybe the improvements increase the assessed value, but from a structural standpoint, they're completely unrelated.
Okay, well, I just noticed that it goes under the taxation code. So that's part of my question was how it fits into that particular part of Muni code. Thanks.
Ms. Kennedy, did you want the administration to address that question, why it's in that particular part of code?
I'll address it. This
Yes,
is Alex looking
thanks.
through the chair. That's just because the part of the code that relates to collection and payment of assessments is in that part of the code, which is why we're putting this piece in there, because it is similar from a structural standpoint. It's just unrelated from a taxation standpoint.
that helps. Thank you. Thank you, Mr. Slivka. Thank you, Mr. Chair.
Thank you. Mr. Constant?
Thank you. I'm gonna skip my question again this time.
Okay, thanks. Mr. Weddleton?
Okay, thanks. You know, in some ways, this gets around a real problem with why commercial properties don't put a lot of money into energy efficiency. And in, I think, most cases, unless you own and operate and use the building, your tenants pay for their own utilities. So if you cut their utility costs by investing a bunch of money, there's no return on investment for you. So this, and Mr. Schutte, or someone had sent to this administration, and they said that in some cases, you know, where you have a lease that's triple net, you could pass this on like you would normal property taxes. So that gets around that problem if your tenants can stand it. But it is pretty neat, because that has been a real stumbling block for getting commercial buildings to, have a real, financial incentive to do energy improvements. That's more of a comment. Thanks.
Thank you. All right, I'm not seeing anyone else in the queue. Please continue, Ms. Kilcoyne.
Thank you for the good questions. Okay, so next we'll talk about property tax credits. HB 232 was signed into law May of this year, and multiple assembly members expressed interest, and I think this is a really great opportunity. CPACE works for commercial buildings, but this would include an incentive for residential properties. So it enables a municipality to provide an air quality improvement tax credit to offset a portion of property taxes. And what I like about this, it has the flexibility of new construction as well as renovations that aid in air quality improvements in the municipality. And so we would have to establish eligibility criteria for these credits. I've been working with Mr. Schutte, Mr. Slivka, Building Safety, Finance, and Treasury to develop this program. We're reviewing existing programs, including federal programs, which are sunsetting. And it's been kind of a balance. So what will incentivize people to install high efficiency equipment versus what the municipality could allow to offset in tax income. And we kind of think of it in terms of when you're talking about an incentive, you're trying to catch people at the end of life of their equipment generally, because it's not going to be enough to encourage somebody to say, buy a new hot water heater when their existing hot water heater works sufficiently. It's not going to be that kind of money, but at the end of life of their hot water heater, they might say, well, I can get this cheapo one over here and install it, or I can go up a level and that might cost me a little money, but this helps offset the difference. And then after I install it, I'll be saving energy throughout the life of that project. This program can help stimulate investment in new development or redevelopment of properties. And let's see. Oh, next slide, sorry. So we're still working on the details. And so what I'm sharing with you today is kind of what we're considering for a program. And there's not a lot of detail here because we're in the middle of looking at all of those details. So what you'll see is potentially eligible projects here. The applicant must also obtain a building permit, and for commercial properties, they're already going to obtain a building permit, but this is important for properties or for projects that might otherwise not get that building permit, because we need to verify that the installation was done at the correct property. Otherwise, there could be potential for people to buy hot water heaters and sell them and try to take the credit. So we need to be careful about those kinds of things. What we're envisioning is a 1-year tax credit, and you could apply for multiple items, but there would be a maximum credit allowed per year and a maximum credit over a number of years by parcel. For example, if you put in a new boiler, a new high efficiency boiler and a water heater in your home, the boiler might allow for a $250 credit and the water heater would allow for a $150 credit. These are example numbers. These are not the final numbers. And so you'd be looking at a $400 tax credit on your property tax. But maybe you also did some insulation, which brings you up to a $600 credit. You could still only apply for a maximum, which would, for example, be $500. And when we're also thinking about what we want to incentivize, one of the basic pieces of equipment that can really save energy and money is programmable thermostats. So I'm really interested in allowing for a, say, $50 bonus credit for a programmable thermostat, if that's installed at the same time as an eligible upgrade. So again, we're really still working on the details of this one. If anybody's interested in working with us, I'd be really happy to get your input. New construction must, if you're applying for new construction for residential or commercial, that must meet certain existing standards, such as, say, a 5-star plus or 6-star rating, passive house, LEED certified. There's all sorts of different examples for certifications, and we would want to pick what makes the most sense for Anchorage. And maybe it's not going to be something like LEED, but instead it could be you use this level of insulation or these types of HVAC equipment, that kind of thing. These are some of the eligible projects, and this you may notice lines up with PACE eligible projects. We, to the extent possible, would like the programs to be able to work together so that it's easy to work to apply for both if you're doing a project, at least in the commercial realm. So that's a pretty quick overview of property tax credits. I'd like to pause for questions on this policy, which is really in the developmental stage.
Thanks. Are there any questions at this point? All right, I'm not seeing any. Please continue.
All right, excellent. Lastly, the Anchorage Clean Energy Jobs Fund. This is also known as a green bank, and I hope you don't mind. I am going to use these a little bit interchangeably. I don't like the term green. I don't think it means a lot, and so I'm trying to be more specific and naming this a Clean Energy Jobs Fund. This is not a bank in the traditional sense. Green banks are not deposit holding institutions. The term green bank is a description of the kind of role an entity plays in the market. Green banks are financial institutions that use its limited funding to attract more private capital into affordable financing of, again, energy efficiency and renewable energy projects. So this works with the private sector to accelerate the deployment of clean energy technologies. And this may sound risky, especially if you've never heard about it, but really it's about looking at where those market gaps are and where capital is needed, which currently is not really how banks operate. So they're not going to see that there's a gap in clean energy financing. So how can I, for example, do outreach and education and figure out what technical assistance is needed to meet that gap? Whereas green banks are market-oriented institutions, and their mission is really to develop those underserved markets. Green banks in the US have driven over $5 billion in total investment, including co-investment from the private sector. I'll get more into that in a second. And Anchorage does have a community of traditional lenders and other market participants who have expressed interest in doing more clean energy finance. So that's exciting for us. However, banks typically take time to adapt to new markets. Most are not really familiar enough with clean energy projects for residential or commercial to take the lead on these. And so that lack of familiarity really increases risk in the eyes of traditional banks. And that results in clean energy finance offers with higher interest rates and shorter payback periods. And those can be non-starters for residential and commercial borrowers. This report, the Clean Energy Jobs Fund Opportunity Report, was funded by the Municipality of Anchorage and the Alaska Conservation Foundation, and it was supported by Renewable Energy Alaska Project. This was completed this May by the Coalition for Green Capital, or CGC. They're the leading US expert on green banks. And this process included interviews with over 30 market participants and an analysis of existing data sources and policies, and a review of relevant reports. I'll also note that this was attached to the resolution of intent for a CPACE. I know at least Mr. Weddleton read it. He had some good questions on it, but I can share that again if you'd like another link to it. CPACE, so some of the identified markets we have here are CPACE, small scale solar, and residential heating and electric efficiency. CPACE is an ideal program for a Clean Energy Jobs Fund. This is just kind of agreed across the board. And especially since we're close to having a program created, CGC finds that the opportunity in small CPACE lending is particularly strong. As CPACE nears launch in Anchorage, early support from a Clean Energy Jobs Fund in this market segment could really help set the program up for future growth. CGC estimates that with an initial capitalization of $5 million, the fund could finance 25 new CPACE projects, ultimately resulting in over $700,000 in energy savings and the creation of 70 new jobs in the municipality. Over time, if the Clean Energy Jobs Fund could leverage its $5 million to generate $50 million of CPACE loans, then we could expect to create more than 700 jobs. these estimates are just for small CPACE loans. The fund impact could be significantly larger if it was given sufficient capital to grow into other markets. In addition to providing financing, the Green Bank could also deliver needed market development activities such as data collection, trainings, and marketing to assist in the pipeline of clean energy projects. These lower the barriers to clean energy finance and would allow businesses to more easily expand their offerings. In small scale solar, actually, Alaska has seen a significant growth in its solar market. I'm sure you've seen some of these popping up around town. At the end of 2019, our net metered renewable energy systems and the grid and the rail belt grid had an installed capacity of 5.6 megawatts. That may not mean much, but that's a 74% increase as compared to the end of 2018. So that's huge. Despite this growth, the overall solar market remains small relative to many northern states and lower 48 states. Maine, for example, added over 15 megawatts of non-utility solar in 2019 alone, another northern state. Many of the projects are for residential around town, and it's still a large out-of-pocket expense that can be a barrier for many households. And I haven't seen a lot of commercial dipping into solar very quickly here in Anchorage. And then on energy efficiency for residential, according to the Alaska Housing Finance Corporation data, the residential sector has the potential for heating energy reductions of approximately 30% through efficiency. And they estimate that since we know that about 20% of buildings have gone through efficiency upgrades, that we've got the potential for about 80% of homes in Anchorage, which sums up to be a savings of about $34 million per year in energy costs. And that would be through an investment of about $217 million. The home energy rebate program, I'm sure that some of you remember this program. It wasn't too long ago that it existed. It no longer exists now, of course, and the weatherization program is a much smaller version of what it once was. And this is a market gap that really the fund could help fill. The green bank landscape. There are 14 green banks in the US with several others under development. This is a market that's growing pretty quickly. And there can be really a variety of structures. We've seen that cumulatively Green Bank impact through December is $5.3 billion of total investment. And that's 1.5 of Green Bank money for $3.8 billion of private money. That's a 3.6 to 1 leverage ratio, which is pretty exciting. For every $3.6 of private funding, they're using $1 of public funding to make these projects happen. What I really like about green banks is they can use various techniques to offer favorable terms to clean energy projects. And that can be loan guarantees, dedicated debt, technical assistance, and lower cost or longer term loans. And so it's hard, it sometimes can feel complex to say what a green bank is because it can be many different things. It really depends on what kind of market barrier we're looking at. Green banks have achieved those market gaps in a variety of ways. And so they can also support market developments through things like information sharing, developer training, or program coordination. Earlier stage green banks have traditionally focused on one or two solutions that they seek to establish themselves. And for that, we'd probably be looking at CPACE. That would be the obvious one for us. While larger, more mature green banks have often expanded their offerings to a whole set of things. And an example of what I mean by this kind of variety of techniques is if the barrier for us is to invest in perceived project risk, the fund could provide a loan loss reserve as a credit enhancement to mitigate that risk and allow investment to flow at longer terms or a lower rate. I'm going to give a couple of examples of green banks that exist already. The Connecticut Green Bank is Connecticut's quasi-public green bank, and they've used $250 million in public funding to drive over $1.6 billion in overall investment in the state's clean energy market. The Connecticut Green Bank has a revenue stream through a surcharge on electric bills, and while it's small, that's not really a likely capital stream for us. But they have now a leveraging ratio of anywhere from 3.1 to 11.1, or sorry, not 0.1, 11 to 1. Again, $11 in private investment for every $1 in public. I want to point out that Bert Hunter is the Executive Vice President and Chief Investment Officer of Connecticut Green Bank. And some of you may recognize that name. He's been to Alaska twice. He's also the chair of the Montgomery County Green Bank. He is very generous with his time and expertise, and I'm sure would be willing to speak with any assembly members if they're interested in learning more. I liked part of Energize Delaware because one thing I want to point out here is they closed 22 commercial low interest loans, financing $5.2 million in energy efficiency and clean energy projects. That's particularly exciting to me since we're currently working to establish CPACE, and that market mechanism is kind of ready to go for commercial. The National Climate Bank, I don't know if folks have really heard much about this, but this could be a powerful tool for economic redevelopment in the wake of the pandemic. The proposed Clean Energy Jobs Fund, as envisioned in the National Climate Bank Act, is a nonprofit corporation independent of government whose mission is to invest in projects that create jobs while mitigating the impacts of climate change. This act proposes a $35 billion nonprofit institution that would have the ability to provide capital both to projects and local green banks. So Coalition for Green Capital Analysis estimates that this could mobilize $1 trillion towards clean energy projects. I think this is exciting. If we were able to look towards a clean energy, a local clean energy jobs fund, this could be a path towards getting it capitalized. If we don't do that, we could still look at getting projects funded through it, but we're still waiting to see what some of those details are. I'll point out that this has already passed the House of Representatives twice since July, and Kamala Harris is a co-sponsor of the bill. So that makes this opportunity very likely if the Democrats take the White House, and I don't know how likely if they don't. So what does that mean for us? Well, there is a meaningful green bank opportunity. Our report finds that it will be challenging for an Anchorage-only institution to generate sufficient scale to support a fund's operating annual cost. This is an important consideration because unlike grant-funded institutions, green banks are designed to earn returns on those investments that cover their operating costs. And this allows for, institutional growth over time. We are working to develop a light version that would leverage the existing capacity we have in the municipality. We would want to create an advisory committee to help us do that, and that would have to be done in the near future. We would decide where that fund would be housed, identify market gap and opportunities, create a business plan, and lead stakeholder outreach. A light program also means we would ideally hire an external underwriting company such as Alaska Growth Capital or Cook Inlet Lending Center, and continue to work with Coalition for Green Capital and existing green banks to create education and outreach materials. Some of the bigger questions we still have is where would we house this? ACDA appears to be a potential fit. They're a quasi-public institution of the municipality whose mission is to engage in community and economic development opportunities. And we believe we could operate the program starting with just one program manager if there is indeed a good institution for it to sit in. But we would need operational and capital funds, of course. So these are among the biggest next steps for us. Fortunately, I've been working with some of our smartest people, Alex Slivka, Chris Schutte, Bill Falsey, and Aaron Baca on this. And I'll note that Aaron just hired a brilliant mind, Melanie Lucas-Conwell, who did her master's thesis on an Anchorage Green Bank opportunity. So that's kind of where we're at. We've got more questions than answers at this point, but there's a great potential here, I think. And so it's something that we're very interested in seeing how we could move it forward. I don't have a specific question or proposal for the assembly on this item today, but wanted to share this information. This is something that I'm excited about and would love to hear any questions or concerns from you. And that is what I have today. I also could offer to connect you with experts from Coalition for Green Capital, or of course the Connecticut Green Bank. We've got good contacts there that have been incredibly helpful. And if there are questions, I'm ready to take them.
Thanks so much. We'll start with Ms. Zolotel.
Thank you, Mr. Chair. And I apologize, I didn't get into the queue fast enough for the middle presentation. I just wanted to flag that some of the items that you're considering, it'd be great if we could be making sure we coordinate as we look at the storm water utility and what that menu of options might look like. Just, it seemed like there might be some overlap on some of those items, particularly around water runoff mitigation. So I just wanted to flag that, and hopefully there's good coordination going on between different departments.
Thank you. I had not thought of that, so I appreciate that comment.
Thank you. Is there any other discussion? All right, I'm not seeing any. Well, I really appreciate the presentation, Ms. Kilcoyne, and I'm sure we'll keep engaging in this. Looking forward to future updates. With that, I'll go ahead and end this work session early, and we'll see everyone at 1:50.